The matching principle is a fundamental accounting concept that guides how expenses are recognized in financial statements. It is a key component of accrual accounting, which aims to provide a more accurate representation of a company's financial performance by matching revenues with the expenses incurred to generate those revenues within a specific accounting period. The matching principle helps ensure that the financial statements reflect the economic reality of a business's operations. Matching principle in accounting. Recognition of expenses. According to the matching principle, expenses should be recognized in the same period in which the related revenues are recognized. This means that costs incurred to generate revenue should be matched with the revenue they helped generate. Timing of recognition. Expenses are recognized when they are incurred, regardless of when the cash payment is made. This is in contrast to the cash basis of accounting, where expenses are recognized when they are paid. Systematic allocation. If the benefits of an expenditure extend over multiple periods, the matching principle requires that the cost be allocated systematically over those periods. This helps ensure that expenses are matched with the revenues they help generate over time. How the matching principle guides revenue recognition. Accrual accounting basis. The matching principle is a cornerstone of accrual accounting, which recognizes revenue and expenses when they are earned or incurred, regardless of when the cash is received or paid. This ensures a more accurate representation of a company's financial performance. Revenue and expense pairing. The matching principle dictates that revenue and the related expenses should be recognized in the same accounting period. For example, if a company sells goods in December but doesn't receive payment until January, the revenue and the associated cost of goods sold, COGS, should still be recognized in December. Direct and indirect costs. Direct costs directly tied to the generation of revenue, such as the cost of goods sold, are matched with the corresponding revenue. Indirect costs, such as overhead expenses, are allocated to the relevant periods based on a systematic method. Operating expenses. Operating expenses, such as selling, general, and administrative expenses, are recognized in the period in which they are incurred and contribute to the generation of revenue. This ensures that the costs of running the business are matched with the revenue earned during the same period. Recognition of depreciation. For long-term assets with a useful life extending over multiple periods, the matching principle requires the systematic allocation of depreciation expense. This aligns the cost of the asset with the periods over which it generates revenue. Example illustrating the matching principle. Let's consider a simplified example. Scenario. A company sells products in December and receives payment in January. The cost of goods sold, COGS, for the products sold is $10,000. According to the matching principle, both revenue and the associated expense should be recognized in December, the period in which the goods were sold. Accounting entries. In December. Revenue recognition. Credit sales revenue, $10,000. Debit accounts receivable, or cash, $10,000. Expense recognition, COGS. Debit cost of goods sold, $10,000. Credit inventory, if applicable, $10,000. In January, when payment is received. Cash receipt. Debit cash, $10,000. Credit accounts receivable, $10,000. By following the matching principle, the company ensures that the revenue and the associated expense are recognized in the same period, providing a more accurate representation of the business's financial performance. In summary, the matching principle in accounting aims to align revenues with the expenses incurred to generate those revenues, emphasizing the importance of recognizing economic events in the period in which they occur rather than when cash transactions take place. This contributes to more accurate financial reporting and helps users of financial statements make informed decisions about a company's performance.